Retirement has the ability to be over a third of your life. And knowing what you don't know may mean the difference between making sure you have a great retirement over just a good retirement. That's what we'll be talking about today, of how to risk manage retirement correctly on the things you don't know. On our show today, we are going to be talking a lot about what retirement looks like and the things you may not know and how that's going to affect your retirement. So that's what we want to be talking about today, and there's multiple aspects to retirement. And what we want to do on Enriching Wealth is teach you how to risk manage your retirement correctly. So one of the aspects is the wealth you have and how that translates into making sure that the money you have can create an impact through your work, your company, through your family, and through your community. Now, what we want to do is be discussing all of those details that you may not know, starting with tax breaks. You see, when we talk about taxation, there's a lot that comes into your age, and the older you are, the more deductions you may claim, especially on a standard deduction. So as you are getting into retirement, as you are retirement age, so that is classified over 59 and a half, but more so as you fully retire and start to actually plan for the next stage of your life, that's generally over the age of 65 for many of you. Now, with that, there are tax breaks that you may be qualifying for that you had not previously qualified for. So as you're going through your taxes, it's actually a very good thing to look at your taxes and to determine, because of your age, if there are any additional breaks, tax breaks that you may be able to claim that you had not already claimed. So that is something that be aware of. That is something that you need to be proactive about as well, and making sure that your accountant or even your tax software is just up to date and knowing all the deductions that you are able to take for your age and where you're at in your stage of life. Number 2, Medicare doesn't cover everything. You know, there's an old saying that's out there that when you have your health, you can have 1,000 wishes. But when you don't have your health, you have but one wish. That is true, because even with an exorbitant amount of money, say hundreds of millions of dollars, if you don't have your health, what good is that money? And I have actually been around individuals who have had $150, $180 million who have poor health. And what has ended up happening is that their health has declined so rapidly that they start seeking out other individuals, other doctors, to try to help with that. And they spend a lot of their money trying to figure out their health and trying to get better. And when that doesn't work, they try something else and keep trying something else. So yes, they have the wealth aside to make this happen, but they're not getting any healthier. And so when they look back on their life, they would trade gladly their wealth for their health. Now, what I'm talking about here is that when we take a look at what's going to keep you healthy, that's part of your health insurance. And when you are retirement age and 65 and older, you jump onto Medicare. Now, Medicare is a lot of different kind of plans pulled together. So we have Part A, Part B, Part D. We have a lot of different parts that are just subject to anything you can be signing up for right away. But that's not all. You see, we have Part A, which is a big piece of your kind of emergency care type of coverage. And then we have Part B, which is more of your primary care type coverage. Part D is drug coverage. But when we take a look at all of the different aspects of Medicare, it does not cover all of your insurance needs. So if you are going to stay healthy in retirement, you need to make sure that you take care of all of the aspects of the health insurance that's going to keep you healthy. So what happens when it doesn't cover everything? Well, we need an additional plan. So that's where they come into Medigap policies. Now, Medigap policies are additional policies that you can get that are going to cover those specific areas that Part A, B, and D don't cover. Now, what's more, most of you are not going to get a Medigap policy. You will get supplemental coverage. Now, that is more so in the lines of from a private insurer that's going to be covering all of the different aspects of your medical needs. So know that your health is vitally important, and the aspect that you are going to need additional health insurance even in retirement. Number 3, your age matters. Now, we just got done talking about age 65 with Medicare. That is a huge number that you need to be aware of, because that is going to be the difference between paying maybe thousands of dollars in health insurance premiums and paying hundreds of dollars in health insurance premiums. But that's not the only number that you need to be aware of. You see, between ages 62 and 70, you have other aspects. What are those? Social Security. When to take your Social Security benefit can be the difference between having your benefit be paying out a standard of living until, say, 80, or even having a standard of living that's going to be helpful through age 90 or even 95. You see, what happens is that we want to take the most money out of Social Security, and to do that correctly, you have to know your numbers, what's going to be important for you, and the best ways to claim Social Security. So knowing your numbers, your age, and all of the different aspects is going to be vitally important. So we have Medicare, we have Social Security. Those are going to be important. Well, what else? How about the number 59.5? That number specifically is when we can take money out of your retirement accounts without penalty. So now we can start taking money out, we can start shifting things around, and we can start doing more retirement planning around your accounts. So 59.5 is vital. We had 65 already. We had 62 to 67 for Social Security. Now, we used to have 70.5 for your required minimum distributions, but that is no longer. Now it's increasing. So now we're at 72 for required minimum distributions, and it may actually increase in the future as well. So when we take a look at all of the different aspects of the ages that you need to be aware of, there is a lot of different abilities to take money today at 59.5, to take income in the future that's required at, say, 72, to take Social Security on a gradient scale, and when to claim Medicare at age 65. So all of those numbers mean something, and having a plan in place of when to take everything is going to be vitally important to make sure, first of all, that you have the money and the income you need, and secondly, you can risk manage it so your money does not run out. So whether you have $100,000 or $100 million, making sure that you have the correct strategy of how you're going to be utilizing your money in retirement is vitally important. Taking from your nest egg. When we look at retirement, I talked about the fact that we have ages that matter. One of those ages is what I called your required minimum distributions. And that is true because we have a time in place where out of your retirement accounts, you are required to take money out. So that's why we call it the required minimum distribution. The minimum amount you need to be claiming outside of your retirement account and from your retirement account to make sure that you satisfy all of the laws that have been placed. You see, what happens is that you have been given 72 years to basically save a lot of this money, and the government says, you know what, we want a little bit of our taxes today, so we are going to require a certain amount of money to come out of the accounts. Now you can find that amount in the percent based upon your age that comes from your unified tables. So those are published tables that you have. So you can have access to those from the IRS website, or you can even have a lot of different required minimum distribution calculators that will calculate the exact amount from the money that you have in your retirement accounts and making sure that you take enough money out of them. One thing to know here is that if you have a 401k and an IRA, they're both retirement accounts, but you have to make sure that you're taking money out of both of them. You see, some of the accounts you can kind of lump together and take more from one and none from the other, but there's other accounts that you need to claim that money and take it out of, irregardless if you've taken it out of other accounts. So to know which accounts and to know the laws means just doing a little bit of research, but just know that there are going to be times where you're required to take money out and that you may have to take out of more than one account to satisfy all that you are required to take. So with that, just know that you are required to take money out of your accounts and that you're going to have to pay taxes on it. So we're not getting past those taxes on your 401k accounts, on your traditional IRA accounts, on your SEP IRAs, on your simple plans, your qualified pension plans, your qualified defined benefit plans, they're called, defined contribution plans. All of those are taxable in retirement. And that is the reason why just having, again, a strategy in place can help you risk manage your taxes. When we talk about your nest egg, you have done a great job of saving, and so much so putting money away. Now we have to take out a certain amount every year just to make sure that you have the standard of living that you want. Now, again, want is going to be subjective, so your standard of living is going to be different than everyone else's, but we need to make sure we have the retirement income to support that. And so that's looking at your nest egg, making sure that we can take out enough to support your lifestyle, but not too much that we're going to deplete it sooner than you have wanted. So what I mean by this is that there's going to be a time when you have more money at the end of your life. That is when you can pass it on to your heirs, to your kids. You can leave it as a legacy as part of maybe say charitable organizations. You have a lot of options when you have more money at the end of your life. But what happens if you have more life at the end of your money? That is a recipe for disaster. And I know that's one that you do not want to kind of be entangled in. So what can we do to make sure that that doesn't happen? Well, it's taking a look at where you're at for retirement and making sure we have a strategy for withdrawing the money out of your accounts. Make sure we know how much we're going to be taking on a yearly basis and the probability that it's going to last all of your retirement years. You see, when we take a look at that, the whole idea now is that we have the ability to have more money at the end of your life and not the other way around. In retirement, you can keep saving for retirement. This one is fairly straightforward, that there are going to be some aspects and some accounts that if you are working, you have the ability to continue to keep saving money into even after you turn the age 72. So, if you have decided that you don't want to quit working, you don't want to retire, which is actually a great aspect because it keeps your mind sharp, it keeps you active, and it keeps you doing the things that you want to do and love. Well, if that is earning income, there may be great places that you can continue to keep saving that income for, whether it's a future retirement or whether it's for getting some tax benefits off of it. That is the reason why having kind of a look into your income, a look into your savings, especially as you get into your 70s, is going to be very helpful, because some places you are unable to save money into, but others you have the exact benefit that you're going to be enjoying by being able to put money away for retirement even if you are not retired. And that leads us to our last aspect, taxation. You see, when we look at your traditional IRA accounts, your traditional 401k accounts, Social Security, many of your pension plans that you have, those are taxable. Taxation is going to be a huge aspect to your retirement. Now, I have some bad news. The information that you have been fed through the media, from the newspapers, from the news that you've been watching over the last probably about 20 years, has really talked to you in the fact that just put money away for retirement, and in retirement, you will probably pay less tax than when you're working. Well, the news and the bad news I have for you is that most likely that's not going to be the case. I mean, there's going to be some aspects that change. Yes, you no longer are going to be paying into Social Security or Medicare as part of your taxes if you do not have earned income. So yes, that aspect is going to change. But the thing is, as you take money out of your accounts, most likely you may actually stay in the same tax bracket, or may even jump a tax bracket depending on your income and depending on how much money you are required to take out of your accounts. So what do we do about that? How can we make sure that we stay in a lower tax bracket to keep our taxes lower? And yes, this is called risk managing your tax brackets then. So if we want the money to last longer, one way to do that is make sure that we don't have as much in taxation that occurs. So what we can do here is take a look at the different tax buckets we have. Now, you may have heard of the tax buckets before and understand the concepts. So we have the taxable buckets. That's the ones like your individual accounts, your non-retirement accounts, your jointly held accounts, bank accounts, brokerage accounts, ones that you're putting money into and you can take out at any time, and any of the growth you pay tax on. So that tax then would be subject to how long the money has been invested. If it's under 1 year, then it would be short term. If it's over 1 year, it'd be long term, and those can come back to capital gains. So that's something to know. There's going to be taxation on those taxable accounts. Then we have a tax deferred bucket. That bucket itself is going to be what most of your tax is going to come from, because remember, you're putting money into these accounts. So like your IRAs, your 401ks, defined contribution plans, you're putting money into them where basically you're not paying tax on that money to go into the accounts. And because of that, when you take money out of the account, it's going to be taxable. So every dollar you take out of those accounts are going to be taxable. So we have the one that is going to be taxable just in general when you take money out of it, and any transactions as capital gains. You have one that is going to be taxed later when you take money out of it in general, and you're going to be having a third bucket. That's the tax-free bucket with Roth IRAs, Roth 401ks, and different types of accounts that are going to be very beneficial to you. So we have the three different buckets, but I would actually argue there's going to be a fourth bucket that you should look into and make sure you have money filling up that bucket. What is that bucket? It may be one that you are not as familiar that you can be drawing from in retirement. Life insurance. You see, specific types of policies have the ability to basically save money and encapsulate money within those policies themselves. And we can take money out of there as part of the loans tax-free. So the best aspect, if we have taxation in retirement, how can we manage each of those buckets? So even that fourth bucket that you may not have thought of, in order to receive tax-free income. If we have some tax-free income, we have some taxable income with capital gains income, and we have your traditional IRAs, 401ks that are still subject to tax, but if we can look at each one uniquely, there may be opportunities to reduce your taxes in retirement the exact way that you have been understanding it for the past, at minimum, 20 years. So with that, there's been a lot of strategies that we have gone through here, and just knowing where you're at for retirement and the things you don't know is going to be helpful to make sure you have a long, prosperous, healthy, and a retirement that you will have the joy to make sure that you're going to outlive the money you've saved. If you want more content, tips, strategies on your wealth, please check out all of the other content that we have here at Enriching Wealth. And as you have questions, feel free to reach out, because we can help to make sure that you have the plan in place that you need for your own personal wealth.